Good morning. Welcome back to this series on covered calls, which is a practical walk through the way that you can apply this strategy to generate more reliable income. So let's jump into it. So we're tracking two stocks here. The first one that we'll look at is Apple, and we initiated this series of transactions at the end of June. In the first exercise, the price of Apple rose and the stock was assigned away, and we were left with an income of 2.02%. We then repeated the exercise. We bought the stock at a little bit higher price, $150.58, and we sold another call at that point and achieved $2.90, or an income of $290. Now, again, the stock price finished the period above the strike price of the call, 152.50, and so the stock was taken away from us again, but we get to keep the premium, and so we got another 1.9%. So all up over the 2 months, we've gained just a touch under 4%. Now, you could argue that had we just bought the stock instead, that we would be up around about 9.5%, and that's true. And that's the whole point of covered calls, that you are basically swapping the potential upside that you could get from the stock for the greater reliability of the income. And let's face it, if you can generate 2% income virtually every month, that's 25% a year, which is for most people an extremely attractive income. Now, of course, the other way to look at this is if Apple hadn't gone up, if the stock hadn't gone up, and it had just stayed the same, then you would have made no progress. Whereas this way, you would have made nearly $400 worth of income. So everything in the market is a compromise, and that's the compromise we're making. So let's move on to the next stage. So on the 24th of August, we did this procedure again. We bought 100 shares at $159, and we sold to open 1 September week 5. So that's just a fraction over 4 weeks from now. September week 5, $160 calls, and this time we were able to get a much better premium. So the premiums have improved since the last time we did this a month ago, and so we're able to get an income of $470. So that adds another 470 to the nearly 400 we've got, and pretty much makes it the same. If the stock price doesn't move by the end of September, then we've pretty much got the same outcome as if we'd bought the stock, and yet we've got the added reliability of the income. So that's Apple. Let's look at JP Morgan now. So just to recap, we got 1.52% the first time we did it. This time we got another 1.71%, but this time the stock price finished just below the $91 strike price on the calls. Wasn't by much, but it was just below it, which meant that the option expired worthless. So we retained the $155 income, but we also retained the stock. So unlike with Apple, where the stock was assigned away from us and we had to buy the stock again to continue this process, in this case, we still own the stock. So all up, we've received 3.2% income. And if we move on to the next slide, you can see that if we just bought the stock at this point in time, our gain would have been 5.4% on the stock. We've received 3.2% on the calls, but we've now just written another call and received another 1.9%. So that's almost the same as if you'd bought the stock. And yet again, you've got the reliability of that income stream. So I'll keep tracking this for a few more months to give you a really practical insight as to how this unfolds. But hopefully you can see now that if we can generate somewhere between 1.5% and 2% every month and do it with a great deal of reliability, that this is something that could be extremely attractive to a lot of investors. I'll be back with you next time. Cheers.